I don't know if I did this right. Oh, Chris is on there. Guess I did it right.
What's his wife do?
She's a payroll person. I forget where. Route 73, I knew that.
Good morning.
Yeah.
There you go.
Thank you so much. Her orange skin is on the floor.
That's fine. Like,
His trampoline in the front yard.
It should be good. I need to get out again.
park the car. Doesn't unlock unless you touch it. Okay.
Look on this. I wonder how I not talk. All right, he's got that. Thank you. There's some new paper.
Can everybody hear me? I see everybody's muted, but can anybody hear me?
I got you.
Okay. Who's that?
Chris.
What's up, Chris? All right, we'll give it a few minutes to see if anybody else is going to join.
I don't have to share it.
Looks like Ken's looking for the link.
Yeah, Nicole Dillon just texted me too.
You can't get on.
Zoom?
Yeah, it's on Zoom.
Can you set me on? I don't have that. That's not a Zoom.
One second.
Look at his hair. This is what I look like in the morning.
I put the payment through. I got the.
So how do I not see him? Guess your daddy knew, huh?
Chris, I think you're muted.
I am muted. There I am.
I thought you were saying something.
No. All right, guys. I appreciate everybody time. I'm going to give it a couple more minutes because I know there's 2 more people trying to get on right now. And then we'll get started. But by all means, feel free to unmute and ask questions and keep this as conversational as possible. Like I said, I do this in person a lot, but not online. So, I'm not used to the quiet time. So, by all means, ask questions as much as you want. Okay. But like I said, I'm going to just give it another minute or 2 here. All right, waiting for Angelo and Ken. See if
Hey,
they're-
everyone, I just
Ken's
got
there.
on.
Yeah. All right, Ken's there. All right, well, they'll join in when they get in. All right, so just want to, I know that, some of us are, what's up, Ken? What's up, buddy? Some of us are newer, some of us are more experienced. So, what we're going to cover is going to, be somewhat generic to some of you and more enlightening to others. So we'll kind of just start with an overview and kind of, touch on a lot of different subjects. By all means, feel free to ask any questions or to stop me and if you want me to focus on something, I'll be glad to. But
the hell are you watching now?
so we're going to go over, I think, a couple of things that are important are just how we can work together as realtors and loan officers and kind of make the process a little easier. So that would be basically understanding that process a little more. basically starting with the pre-approval process itself. Unfortunately, in this industry, nobody comes to the mortgage lender first, like you would think they should. They would start with the realtor. So I think the more that you understand it, the better off you'll be just for yourself, really. So with the pre-approval, when somebody comes to us, I try to do as much due diligence as possible, because the last thing I want is for that loan to fall apart through the process. So, just gathering the documentation and going over what that documentation looks like, for different types of buyers. With W-2 employees, it's the easiest process, for us. We can really issue a pre-approval very quickly if the customer's, savvy and knows their financial status and is accurate with their details. So, with any W-2 employee, we're starting off with getting their last 2 years of W-2s, their 2 most recent months of bank statements, 4 pay stubs, and just doing a calculation of their income. And on the positive side, when it's easy like that, it's the pre-approval is easy, but hardly ever is it that easy, right? Especially nowadays with COVID having an impact on income the way it did. Self-employed borrowers taking a beating the way they did in the past year. So a lot of it has changed and has become more complicated. So, with a self-employed borrower, where typically we want to see 2 years of self-employed income and seeing what that, because you have to remember the accountant's job for a self-employed borrower is to write down that income as much as possible, where it's our job to find that income and bring it back in. So a pre-approval on a W-2 employee may take, minutes to be able to provide to you, where a W-2 employee may take a lot of different work. So, it's again, feel free to ask questions, because this is new territory for me. So basically we do that. We do the credit check. We take a look at the credit and we take a look at the income and the debt to income ratios. So I want to touch on that a little bit, with the debt to income ratios. Every program has a different qualification, has a different threshold for those debt to income ratios. So with FHA being the most aggressive and allowing for the highest debt to income ratio, down to USDA having the lowest debt to income ratio. So for instance, with FHA, they allow you to utilize more than 50% of your income for, oh, hold on a second. Mary's calling in. Hey. I'm in right now. We're in the middle of it. Are you logging on? All right, you got it. All right. Sorry, it was one of the realtors. So with FHA, we can utilize 50% of your debt to income ratio, 57% for the purposes of qualifying you. All right, for your total debt ratio. So with mortgages, you have 2 different debt to income ratios. You have your front ratio and you have your back ratio. Your front ratio is the percentage of your monthly income that goes towards the purchase of this house for property taxes, homeowners insurance, HOA dues, principal and interest. So for FHA, you're allowed to utilize 46.99% of your income for that. And then your back ratio takes all of that into consideration, plus any debts that you carry, whether it's a car payment, whether it's credit cards, anything that you carry on a monthly basis with a monthly payment gets calculated on top of your housing expense to create your back ratio. So FHA allows you up to 56.99% for your debt to income ratio. So it's very aggressive in that way. We're on the opposite end of the spectrum is USDA, where they only allow 29% of your debt to income ratio and for your housing expense and 41% for your total debt. So it varies in between, where VA, if you have strong credit, you can get debt to income ratio qualified up to, I've seen it as high as in the 70s. So you can be very aggressive, but when USDA, when you have tougher credit, they limit you. You're capped at 43%. So it all depends with VA. So to kind of go over different product types and overview of, you know, the benefits of some compared to others, I just kind of figured, you know, I'll go through each and highlight them. So USDA has to be property eligible and income eligible. All right, and there's tools for calculating that and for verifying that. And when we're done, there's 3 different links I'm going to put on the HomeSmart page. This way you can access it. But that is the link to verify if it's a USDA eligible property, and then a link to see if it's income eligible, and then also a link for you guys to double check condo approvals for various loan products, because that's something we come up against as an issue as well. But with USDA, 0 down payment, it needs to be property eligible and needs to be income eligible. So for us on the mortgage side, this is a little complicated because with USDA, you have your income that we're allowed to use to qualify you. But for instance, somebody with a second job where you need to have a 2-year history in order to use it to help qualify, it can be, if they're on that job for 6 months where you can't use it to qualify them, it's used to disqualify them because it gets calculated in to make sure they're not exceeding USDA's income limit. So even though we can't use it to qualify them, it has to be used to disqualify them. So there's a lot that goes into USDA, and it becomes a very complicated loan. But you know, it's a great product if you meet the parameters. So you have a tough DTI where it's 29% for your housing and 41% total, but it becomes complicated. There's additional income that's being earned that we can't use, but still has to be used to disqualify. All right, so if that's confusing, I apologize. And it always carries a small mortgage insurance no matter what, so they don't have to put anything down. So the mortgage insurance is calculated at 0.35, and that mortgage insurance will, basically it's the loan amount times 0.35 divided by 12, and that's your monthly mortgage insurance. They're gonna have that the life of the loan. So putting down nothing is a benefit, but they do have that small mortgage insurance like FHA that will last the life of the loan. All right, it's underwritten as a conventional, you know, same parameters as a conventional mortgage, but the appraisal is kind of viewed the way an FHA appraisal is, as far as chip paint and things like that they nitpick over. All right, so there are some tighter parameters when it comes to the appraisal. All right, now for this product, same as, like I said, it's underwritten like conventional, but the appraisal is like FHA. Then you have conventional, which is, you know, it can vary so many different ways, guys. Conventional mortgage, a lot of people used to think that was a 20% down payment mortgage, but nowadays it's so much more than that. It could be as little as 3% down payment, and that would be for first-time home buyers. They're allowed to use first 3% down payment on conventional. But if you're not a first-time home buyer, you can qualify under 2 different programs through conventional, which is Fannie Mae's Home Ready product and Freddie Mac's Home Possible, which, as long as you don't exceed the county income limits for the area, you can utilize a 3% down payment for those 2 products. And with Freddie Mac, actually, unlike with Fannie Mae, the Home Possible, you can purchase a multi-unit property as long as you're living in one of them with just 5% down rather than 15% down that you would standardly, you know, the standard would be for down payment. So you have a more conservative debt to income ratio when it comes to these products, when it comes to conventional products, but you can put as little down now to be competitive with FHA with 3%. And we have seen a lot of this recently where FHA is just, for some reason, has been demonized in this market, and you know, sellers aren't really considering many FHA buyers right now. So the 3% conventional has become a very popular product. And like I said, through Home Ready and through Home Possible, you can utilize 3% down, even if it's not your first home. And with that, get a discounted interest rate and a discounted mortgage insurance premium as well as a first-time home buyer. As a program incentive. There's differences between these products, obviously, that would fill a board. So if there's anything in particular you have questions about one product over another, please, by all means, ask, and I'll be able to, give you a little more insight. Conventional is more conservative when it comes to foreclosures and bankruptcies, where FHA allows you 4 years after a foreclosure and 2 years after a bankruptcy. Conventional requires you 7 years from the foreclosure and 4 years from the bankruptcy. Their debt to income ratio is a little more conservative, and self-employed income, depending, it could be 1 year self-employed income or 2 years depending. All right, but then the max loan amount nowadays it's been increased to 548,250 before you enter jumbo territory. So that went up quite a bit from where it was last year. As far as, let me see what we have. Mortgage products, that's basically the 4 major ones that we have. Does anybody have any questions about these products or any questions about the differences? No? Okay.
Hey, Chris.
Yeah.
Hey, Nicole Dillon here.
Hey.
Quick question. So for the conventional with multifamily, do they have to live in one of the units like FHA or no?
I'm sorry, say is for multifamily for conventional, you said?
Yes.
So multifamily with FHA, if you're going to move into an FHA multifamily and live in that property and live in one of the units, you can use your standard 3.5% down payment. Okay. With conventional, if you're using standard conventional, even if you're moving into one of the properties, you have to put 15% down payment as a minimum, and 25% if it's, I believe, three to 4 units. But with Home Possible, if they do qualify for Home Possible and they're buying and living in one of the units, you can do it with as little as 5% down with conventional, as long as they qualify for the program.
Does the property have to have a vacant unit?
Oh yeah. So at the time of the appraisal, one of the units isn't vacant, as a condition, they're going to require for it to be re-inspected to make sure that one of the units has been vacated so that the buyer can live in it.
Okay, thank you. That's what I thought. Thanks.
Yeah. No, we come up against that a lot, and we come across where people are like, well, I gave them an extra month and we're not going to settle. And unfortunately, with the way that the laws are for tenants, if they decide not to move out, it becomes very problematic. It's not very simple. This has made news recently too. I mean, it's just not simple to get rid of somebody. So unfortunately, one of those units have to be vacant. All right. A couple of things that do come up that present issues for us on the mortgage side is writing a pre-approval for a single family home, and then it's utilized to go under contract for a condo. Had this happen a few times where, the contract comes back, they went under contract on a condo, but the condo was never verified to see if it could be used for the product that we're using. So it's just important to make sure that we're communicating and just talking to each other. And if you're going out to, to show a condo or a different type of property, that you let us know, because there's work on our end that has to be done. So just be conscious of that, because it can create issues. The condos require additional underwriting conditions. It requires, the condo questionnaire requires to make sure that it's a warrantable condo. Okay. So it's just important that you let us know that. A couple of things that we come up against, that I think it helps when the realtor kind of acts as a second voice, because no matter how many times, I mean this, no matter how many times we tell customers, they don't tend to listen to a few things. And that's one of them being the EMD, right? Our earnest money deposit check. It has to come from a sourceable, account. It has to come from a bank account, has to come from a legitimate gift. And a lot of times the EMD is done, and it's done in a way that we can't source it. So, or at least I always try to remind the client of that and talk to them about that. But as a realtor, if you can act as a second voice, and when they go to present the EMD or when you're talking to them about it, just reminding them of that, because that has come back to to destroy deals. And we always have to come up with a workaround, and it's always a problem. So just always try to make sure, you remember to have that conversation. Another thing that customers love to do, and maybe a reminder from you guys, no major purchases. I had a purchase that, we do a credit refresh within 10 days of settlement, and we did a credit refresh, and there was a new BMW on the credit report. And when I asked him about it, he said, yeah, I went and bought a BMW. I thought it would look great in my new driveway. And I said, I hope it was an SUV, because you're going to be living in it. You're no longer qualified. So he had to go and sell it, have it transferred over to his wife's name, and it became an issue. But people just don't listen, so it's just important that, you have the conversation as well. No major purchases, no, changing jobs, and kind of encourage them to get us their documents, because people love to linger around with providing us what they need. So get us, help us, in that way, have that conversation with them. And, it just helps overall.
Hey, Chris.
Yeah.
One time, many years ago, I had a guy I worked for. He was going to loan me money to buy a condo as a rental property. But the money that he lent me, since I worked for him, he wrote it down as a bonus that he was giving me. Would something like that still pass today?
So, yeah, okay. So if it isn't part of your bonuses, have to have an average over a period of time. Okay. So just because we can't use it as income doesn't mean we can't use it as assets. So if you got a bonus, but you don't normally get a bonus, we may not be able to use that as income, but we can use it as an asset, because it's sourceable. It came from your employer. It went into your account. We have proof of that. So if he gave you $20,000 as a bonus, that can very well be used as assets for you, but it may not be able to be used if you don't have a history of it for income purposes. All right.
Yep.
Yeah. And that again is all part of that pre-approval process, guys, because it can be, things come back. We try to eliminate fires. That's what we try to do. We try to eliminate any potential issues up front, verify that income, take a look at what can be used, and really try to problem solve. I tell people all the time, I'm not the mortgage police. I'm not here to get you in trouble with the IRS. Tell me the truth. Tell me what's going on, and I'll help you figure out how to resolve the issue, or put this together as a deal. A lot of other questions that come up, understanding DTI, I know we touched on it, and we can focus on these guys. I know that they want to have these meetings a little more regularly. If you tell me, if we get some sort of feedback on what you want to focus on, I could focus on a single product for a length of time. I could focus on an aspect of a mortgage for a length of time, but I'm just kind of going over a brief overview. With credit, a lot of times, this is something I tend to specialize in, where unfortunately in this industry, a lot of people just want to give up on a client that isn't clean cut, especially with as many buyers as there are out there right now. But I never do that. I don't tell people no, I tell them what they need to do to get there. So understanding credit, minimum credit scores, with FHA, the minimum standard credit score is 580. With conventional, it's 620. But just understanding the details of credit and how to get a credit score up is just so important right now, because somebody might just be one payment away on a credit card to go from a 602 to a 635 and be able to qualify. So don't think just from conversation, if don't count anybody out. Always try to get them to your loan officer to determine whether or not they're approvable. Okay, because sometimes it's just an easy fix. 203K, you guys coming up against this recently? Anybody working on loans at the properties right now? I think it's going to become a bigger and bigger issue now that I think you're going to start seeing some foreclosures hitting the market, and the 203K market, I think, is going to be something that increases significantly. And it's something that I'm very familiar with. I work on quite a bit. We did take a hiatus during COVID, but I believe everything's back up and running for these products now. But qualifying somebody on a 203K is something that sometimes the borrower has a hard time coming to grips with, where a standard loan, they may be pre-approved for 200,000 and they think a home that's selling for 200,000 but needs $50,000 in repairs is somehow a home that they still qualify for, and it's just not the case. So it's a bit, as far as documentation is and process of these loans, they are a bit more complicated, but the renovation loan is something that I think you're going to see, become more and more popular. So I think going forward on the next time we have something, I could focus, on that product itself, and the differences between a standard product and a 203K renovation loan. But let me see. Does anybody have any specific questions or anything that they want to discuss?
Hi, I have a question for you. My name is Giselle.
Hey, Giselle.
I work with a lot of investors, and I've been looking for something that's more investor friendly. Because as you know, a lot of them don't have your standard W-2 or, the tax income paperwork that a standard worker would have. So can you just touch basis on what loans are more investor friendly? Just a quick summary, please.
Yeah, so I mean, I guess my question would be, what are the challenges that they're facing, right? When you say investor, so there are products out there that are not what they call non-QM, right? Non-qualified mortgage, so that are more bank asset type of programs. That's not your standard mortgage type of program. Whether you're an investor or buying for yourself, you still have to qualify the same way as anybody else would. So tax returns, and this is something that I think we're really good at, where some people don't know what they're looking at with these tax returns, and taking a look at the business returns, and taking a look at whether it's the miles that could be added back in for income that they utilize for work, and really scrutinizing that tax return and seeing what they can add back in. Because like I said, accountants try to remove as much income as possible. We try to add it back in. But when it comes to an actual investor type, there's no specific loan through standard residential mortgages that is an investor friendly product. Now, there are bank statement programs that a lot of investors use, where it's basically your last 2 years of tax, or your last 2 years of bank statements, your deposits added up, divided by 2, divided by 24. So basically you're taking half of the monthly deposits and utilizing that as income, where a lot of people are using that program, to qualify. But as far as, just qualifying for a standard mortgage, you would have to meet the standard guidelines, regardless if they're an investor or not. All right, I had a couple chats here. Let me see real quick. Can you talk about type of pre-approvals and approvals? That was Hakan. You're talking about the difference between a pre-qualification and a pre-approval. Is that what you mean? I'm not sure.
No, I'm talking about the ones that has, you can have a pre-approval, they look at income and credit, etc. And there's also full pre-approval where, the buyer is almost approved. So it's easier to get a loan.
Right. So what I come up against a lot, okay, whether it's a pre-approval or approval, the one company who's just known for the pre-qual is Rocket Mortgage, where they are basing their pre-approval off of nothing. I've had people that come to me and they're like, yeah, I'm pre-approved with Rocket and it's for 400,000. And then I take a look at their income and they're good for 220. Rocket always issues their pre-approval without verifying anything, and they always charge 1 to 2 points on every deal. So, taking a look and really scrutinizing income, is the difference between a pre-qual and a pre-approval. A full approval is really, in mortgage terms, technically it's your commitment. That would be where, it gets beyond the loan officer and it goes to an underwriter to verify things. And there are deals where they come to me where if they're that complicated looking, if they look that challenging, I put it in front of the underwriter or underwriting manager, and I have them approve it based off of credit, okay, and income, you know, and everything other than the appraisal and the property. So that would be your conditional approval, which is, as far as as you're concerned, anybody's concerned, is the strongest thing you could ever do. But we don't typically do that unless one of a couple different reasons. One, if it's a challenging deal and we need to, we really want to make sure that we have it reviewed so that we avoid any fires with that loan. Or, and this happens more times than not, where a deal is in underwriting and the original loan falls apart, and then they go under contract for another property. So in that case, they have that approval from the underwriter already, that we just need to get their appraisal. But the pre-qual and the pre-approval is really where there's a biggest difference. Typically, a full approval, conditional approval, which is really your commitment, isn't issued until underwriting happens. And we don't normally go to an underwriter with that unless we see an issue up front that, and I probably do this, twice a month, where I'll take it to the underwriter, have them review it, and make sure everything looks on the up and up prior to me letting them go under contract. This way we don't have any issues. But that's only when a deal really looks complicated, or we want to make sure that we're avoiding any challenges. Let me see, is there anything else here?
Hey, Chris, I actually had a question as well.
Yeah.
Can you expand a little bit about like the mortgage commitment? I know that's like a date on the contract, and I know you guys issue a mortgage commitment, but I have still seen deals sometimes fall apart after a mortgage commitment has been issued. So like, what are some of the other things that you guys look for, like right before closing, and what does the mortgage commitment entails? Because I have seen it where we get a mortgage commitment, but then they get denied for a loan. Do they get their deposit back?
Right. Yeah. So everything regarding a return of the EMD, that's always going to be based off of your contract. As long as you had a mortgage, clause in there, for the denial of mortgage, then they're going to get their EMD back. So if they're declined for the loan, that shouldn't be an issue. Now, what you see, what a commitment is a conditional approval. And you'll see sometimes that we'll issue what's called a conditional approval instead of a commitment. And the only reason we'll ever do that is because the appraisal's not back yet and we're up against the wall with the date. So if a third party like an appraiser is holding up the commitment, we'll issue a conditional approval, because that's the only difference between the two. Now, a commitment being a conditional approval that has an appraisal back, any one of those conditions that the underwriter is asking for can be a reason for that loan to be declined, right? So whether it's somebody changed jobs and that's obviously can be a game changer. If somebody can't produce the updated bank statements that we need to verify the rest of the reserves, because you have to remember, if we only pre-approved clients who had enough in the bank at the time of the pre-approval to close, you would get very few pre-approvals, all right? Because they're coming, they have additional savings coming from their paychecks, they have gifts coming from family, and that tends to become an issue where, they were expecting a gift, but then for one reason or the other, the donor decided not to. We've had that kind of stuff happen before. But as long as the loan has been properly scrutinized, there really shouldn't be anything that comes back to haunt you. The only thing that would be is, again, I'm sure you've seen them. You get a commitment and sometimes it only shows 2-3 things. Sometimes you get another one and it's a laundry list of items. And any one of those deals, any one of those conditions can be cause for denial if we can't produce it. So, I've had one, it was recently, where the credit looked good, everything was fine. I issued the pre-approval, everything went under contract, and then a secondary search called a MERS search showed that the client had a foreclosure. Now, I asked the client on every application, did you ever have a bankruptcy, foreclosure, this and that? And they answered no to that. And it was only 2 years ago. And her response was, oh, that was a second mortgage. I didn't know it counted. So, there's going to be things that we don't expect. But as long as, the client's been thoroughly vetted, those issues should be few and far between. So hope that answers your question enough. If not, let me know. I'll be glad to expand on it.
Yes, thank you.
Yeah, no problem. I have to learn how to do this picture thing with you guys. You guys ask a question, your picture pops up. Yeah, so any other questions, guys, before we, touch on anything else? No? Okay. Really, that's really it. That's my overview. I know that, I can be product specific. If you guys want to know more about products, I'd be glad to. Or if, you guys want to let me know for next time what you want me to touch on, if you want it to be all about 203Ks, things of that nature. But, unless there's any other questions, that's about it. Oh.
Yeah, I have a question. Not a question so much as if you could just touch base about the 203K loans. I think that would be very resourceful to all of us next time.
Well, I mean, I can explain some now. I mean, it depends on you guys. I mean, I can explain some of it now, how it works and what the process is. So with the 203K, you are going out and finding a product, a house. The client is coming in, they're getting pre-approved, and the debt to income ratio, everything is based off of the after improved value, right? So you're finding a house for 150,000, it needs 50,000 worth of work. That is going to be based off of a couple of different things. It's going to be based off of the contractor's estimate, which becomes very important in these loans. And everything then becomes based off of the after improved value. So, customers have a tendency to think it's just, I approved you for 150. They go out, they look for homes of 150, but it needs $50,000 worth of work, and it doesn't work. So the client has to go find the property, get pre-approved for that property, have the home inspected by a HUD inspector, typically, have that HUD inspection used for the appraiser to determine an after improved value based off, well, not only the HUD inspector's report, but that HUD inspector's report then goes to the contractor, and the contractor has to work up a list of everything that the HUD inspector says what has to be done, because the HUD inspector tells you what work needs to be done on this property for it to be safe and considered, purchasable home. All right, so then the contractor then goes out and works up everything that the client would like to have done, right? That's your wish list of items. So you have your wish list of items that the contractor works up. And let's say he comes back and it's $80,000 worth of work, and the HUD inspector's work was $50,000 of it, right? Because the HUD inspector says what has to be done. All right, so now that final report from the contractor goes to the appraiser, and the appraiser makes a report based off of all of the work that was going to be done. And as long as the appraisal comes back supporting the post-improved value, the cost of the home plus the improvements, and plus what's called a contingency reserve, which is basically a 10% margin of error, right? So if there's $50,000 or $80,000 worth of work, they need an additional $8,000 set aside to make sure in case it goes over. So as long as the house appraised for the total, you're good to go. If it doesn't appraise, then you need to remove some of the items from the wish list, right? Can't remove anything from the HUD inspection. So once that's reconciled, that's used as the collateral. And, then after that, because everything tends to hold up during this process. It's a longer process. We like to see 60 days for them, 45 at a minimum, 60 more comfortably. And then everything is, once those items are back, then it tends to move forward more quickly. But we then, once it goes to settlement, then the funds are dispersed to the client accordingly based off of, the work that's been done by the contractor. But, there's a lot more that goes into it, and, I could definitely put together something for you. But that's just, a brief overview of how it works. Anybody else?
I think there are a couple questions in the chat.
Hold on one second. Okay. Are there exceptions for people who were temporarily or had lapse of employment because of COVID? Okay, so COVID became tricky, right? So it depends on the type of employment it was. If you are a salaried employee and you had a gap of employment because of COVID, once you're back to work and receiving income, there's nothing you have to do. There's it's not like you have to be back to work and averaging income over a period of time. As long as you're back to work, with an exception, if you were out of work for 6 months or longer, you then need to be back at work for 6 months or more. So if you had what's called an extended gap of employment, you need to be back to work for 6 months. Self-employed, they really get the short end of the stick on this, where if your income was down because of COVID, we have to average that. We can't remove that time from your average. So self-employed really takes a beating with that gap of employment due to COVID or slowdown in business because of COVID. Hourly employees, depending on the job, depending on the consistency that they work, we could tend to average it out, where if you have 2 months worth of employment and 6 months was unemployed, we can average it over a year and a half rather than 2 years. So it all depends on the type of employment. They tend to try to make it work, especially if it was COVID related, which we do verify through a verification of employment that it was COVID related, because if so, then we can average that out of the income so that we can increase what the overall income was. Trying to see here. System programs. Yeah, I mean, the down payment assistance programs, I think that was Ken that asked about it. Yeah, they still exist, the $10,000 grant program. The problem that we have with the grant program is that the state determines everything, where if you are a buyer, we are approving and we want to do your loan, but then the state gets a hold of it, because after we approve it, we have to send it to the state. The state then determines whether or not we can do your loan. So they can override our approval, which then we have to go back to the drawing board and start over and figure out how we're going to come up with $10,000 to make up for the loss of the grant. The credit score requirements tend to be a little higher. And they scrutinize the file a little more, but you have extended settlement dates, because we are dealing with the state, and nothing is free. And this is the biggest part, is that where if we are at 2.75% interest rate, but you're utilizing a state grant program, I don't know what they are because I haven't done one in a while, but the state tells us what the interest rate on the entire loan is, and it's always higher than what we would be able to offer, because nothing is free. So they are there. It hasn't been as popular, in my opinion, recently, just because sellers have the pick of the litter, and they're not out there picking FHA buyers with grant programs or more challenging things. But they do exist. And not only that, ones that are a little easier actually are county programs. And a lot of people pass these up because the state program is so popular. Each county for the most part offers a grant program or something along those lines. And we've been doing more of those, where if they go to the county, utilize the program that they have, it doesn't come with them determining our interest rate or the slowdown and having them approve it after we do. So there's some definite upsides to utilizing the county programs that are out there. Let me see. Any questions? Yeah, definitely focus on 203K. As far as new products, we have new jumbo products that are coming out, which we're really excited about, and a couple other things that are in the works. But the jumbo product will probably have to be for next time, just because we don't have the details of it yet. They just started rolling it out, which is something that we've been pushing for. So because after COVID, we had a line of jumbo products, but with COVID, some of the bigger banks stopped buying those loans. But now they're back and opening up that money again. So I could touch on the jumbo products next time. Unfortunately, I don't have enough detail about it to touch on it right now. Let me see. What is the limit for FHA 203K streamline. What is it? Oh, the hard cost of $35,000 for the streamline FHA. So an FHA 203K streamline product is just less burdensome. There's a full 203K and a streamline 203K, and it's a hard cost of $35,000 between everything. As long as it's beneath $35,000, we could do the streamline, which is just less paperwork and less headaches on our end. Doesn't typically correlate to issues for the realtor, but on our end, it's just easier. Let me see. Are there exceptions for people? Okay, can you expand on subject to FHA appraisals? Are they still common right now? You know, I know that FHA catches a bum rap when it comes to appraisals, but you know, all product types require the home to be livable, safe, functioning. FHA does tend to scrutinize it, you know, down to, you know, chip paint, which is a popular one. But, you know, I haven't had many subject to. I did have one recently, Hakan, you were a part of that one. But the subject to appraisal is just that. I mean, I've had them I had them subject to on conventional as well. But let's see, can you expand on it? Are they still common? I mean, I don't know. Has that been a common problem for you guys? I haven't had a lot of issues with subject to. I know a lot of the subject twos recently I've had were subject to getting a tenant out of the property so that it could be owner occupied. Chip paint, removable shed, that types of things. I mean, that's been an issue with FHA, not just now, but always. So, you know, subject to for VA and USDA and FHA is much more common. But yeah, I mean, yeah, there's not much, you know, I can shed on that. It's just always been an issue. How do you find out? How can you hold escrow for now? See that? Yeah, there's no holding, at least with us. And I'll tell you what, I don't know personally, and I talk to a lot of friends that are in this business. I don't have anybody that holds an escrow for repairs that's on the HUD or on the HUD, on the Alta or on the CD. You know, we don't tend to want to know about them. But as far as holding an escrow, you know, we don't do it. And it comes up, you know, every so often, every couple months or so, but it's just not something that can be done. And not many people do them. Oops. Am I missing any questions here, guys? Yeah, it looks like that's all the questions that were in the chat. If anybody has any questions, by all means, just chime in and let me know what they are. Turner asked about the county programs. All right, so the county program, it depends on which county. Every county is different. Some utilize them as a silent second mortgage, very much like the state program, where it goes away completely. Other ones, I believe it's Camden County, that no matter what, you'll always owe 10% that would have to be paid back. So it all depends on the county, but you know, there's never a payment. It's always silent. It's always a silent second mortgage. I mean, you know, no payments. It's recorded against the property, but it's no payment that's due. I believe it's Camden County that does require a 10% repayment if they sell or refinance the loan at the end of it. But you know, it all depends on the county. It varies. And that's also other, you know, links I could provide if you want onto the Home Smart group page so that you can have access to those programs. Anybody else? Yeah, I don't know, Chris. I don't know why Brooke doesn't come into the office anymore. It's been a question that's been asked a lot, but she, you know, you may want to ask her. All right, guys. I mean, unless there's anything else.
Well, I guess that completes your training. But I want to do a special thank you to Mary Lou Santana for putting these trainings together.
Absolutely.
We appreciate her effort to have other agents to gain some more knowledge on certain areas. But if any of our agents here want to have a particular subject on a training, let us know so we can create something like that too. Thank you for everyone for joining, and thank you, Chris.
Yeah, no problem. And I appreciate it, everybody. And guys, I'm available anytime, nights, weekends, anything, any questions you have. You know, don't go into a negotiation or anything blind. If you're not, you know, familiar with the product or familiar with, you know, have any questions, reach out to me. I'll be glad to talk it out with you and give you some insight on it. So anytime you need me, I'm available. Okay. Thanks again.
Thanks, Chris.
Hold on, I'm not, hey, Chris,
Yeah.
I just want to let everybody know that I've been using Chris for the past 18 years. I don't have any other lender except him. And he's never let me down. Very, very few, I should say, not never, but very few. And I continue to use him. So just wanted to throw that out there.
I appreciate it.
that.
And I'll pay you later. I'll come over with that 100 I told you I'd give you.
You can actually pay me by answering my question that I put in the chat.
Which one?
You missed it.
Where is it?
Are
Tell
there
me what
any
it is.
are there any no doc loans coming to the market anytime soon?
Oh, no, the closest thing that's come to the market is the bank statement program. And even that is a hard one. It's something that's a broker only product, you know, so nobody puts it on their warehouse line. Everybody brokers that thing. And it's the closest thing they have to a no doc loan. I think people are still very, you know, put off by what happened in 2008 if you were around to experience it. So no doc is nothing that I've seen coming out, but the, you know, the bank statement program is, I mean, there are rumors. I do always hear, oh, there's products coming on or that was coming on, but I haven't seen it come out. You know, I haven't seen it, and we most certainly haven't experimented with it. I don't think that's something that, given our nature, that, you know, that we're looking to bring on, and most lenders probably wouldn't.
We have a lot of clients in the diner business, and that's why I was asking.
Yeah, I know. I'm working. They all want to buy $500,000 homes, but they all want to tell the government they make $30,000 a year.
Yeah.
Yeah,
Thank you, Chris.
we call that the Greek loan,
Yeah.
Angelo. Yeah. No,
Thank
that's
you.
it. All right, guys. All right. Thanks again, guys.
Thank you.
Thank you.